why would investors invest in early stage opportunities? Now, when you do speak to investors, the issue is with investing in early stage companies, as I said, it is very, very risky. Traditionally, 1 out of 20 startups succeed. So the issue is that the type of investor that are looking for, and the type of conversations we have with early stage investors, they're looking for a bang for the buck, right? They don't want to come into high valuation. They're happy to back an expert 360, which is a disruptive innovator in the technology market, at that $1 million valuation, right, and exit at 20, 30, 40 times. The issue with investing in early stage businesses, your time horizon needs to be minimum 3 to 5 years before an exit. So you need to be prepared to hold that investment for a very, very long time. So these are just examples of how would you as a business owner get capital. So the first part is the co-working incubators. There's a lot of incubators out there, such as Stone and Chalk Incubate or Monash University or the York Butter Factory, where you can actually hire co-working space. So you can go over there, you can hire a desk, it only costs maybe $600 a month. They provide resources, they provide strategic advice. The good thing, you are in the same boat as a lot of these early stage businesses. You can share information. It's a great business, incubation. Look, the big catch, there is a catch. The catch is these type of incubators want to buy basically a stake in your business, right, for very, very little, right? And that's something that you have to really weigh yourself out. Obviously, there's angel and crowdfunding investors. So there's companies like Our Crowd or Equitize or Melbourne Angels or Venture Crowd, which is essentially crowd platform or crowd funding. Does everyone know what crowdfunding is? So an ability to basically share your business into into the crowd, and where guys like us look at that as a form of deal flow. The good thing is, from that perspective, is that you might not have to give that much away. The type of investors that do come into those, call it crowdfunding platforms, are really high net worth investors that want to get access to deal flow that they don't get seen anywhere in the market, whether it is a BHP or Rio Tinto or Woolworth. They are looking for that early stage businesses because they want to back. But in that situation, the good thing as well is that the Equitize or the Our Crowds or the Venture Crowd, you'd hope, have done some sort of due diligence as well, right? And that's important. And then obviously you've got the venture capital route. The thing with venture capital is that, similar to the co-working incubators that really want to take a very, very large stake in your business for very, very little. The positive, obviously, they're very, very well connected. They normally, traditionally, from a venture capital model, they want to get a board seat. And that could be a good thing or a bad thing. I mean, if you're the boss and you don't want to really listen to anyone else telling you what to do, well, unfortunately you have to, because they control 30% of your business and they obviously control what you do. Traditionally, investors don't necessarily like, guys like myself, don't like, depending on where the venture capital round is, to come in just before the pre-IPO, because normally a lot of these venture capital guys or the private equity guys have already made a lot of their money. And when they do IPO the business, they don't leave much for the retail investor.